With massive layoffs in nearly every sector, weakness in manufacturing, car sales and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show here on Stansberry Research. Well, global stock markets are selling off, risk is rising, and the U.S. yield curve has hit its deepest inversion since 1981. What does this all mean? Well, back with me today is Greg Mannarino, founder of TradersChoice.net. Greg, always good to see you. Welcome back to the show.
Great to be here. Thanks for having me. I think it's a completely opportune time for us to be doing this because things are getting crazy.
You know what's crazy, Greg, is that I speak to people and they're like, oh, things seem so quiet these days. There's not really any news out there. And I'm like, really? Really? Actually, there's a ton happening, but maybe, they just don't want to talk about it. But we're going to talk about it, Greg, because you've been quite vocal about how global markets here are absolutely selling off. But I want to start with the yield curve here because, like I said, we haven't seen these levels since 1981. What is this signaling? What is it telling us? What's the truth, Greg?
Well, I always tell people, do your own research on these things. Look up an inverted yield curve. An inverted yield curve is pretty much a big, fat, ugly red flag across the sky telling us that not only is the economy doing bad right now, but it's about to get much worse. On top of this yield curve, which is unbelievably inverted, we haven't seen anything like this before. Well, let me put another perspective on this real quick. If people just, again, let their fingers do the walking, open up another search engine, whatever they want to do, you will see that every single recession, without exception, since 1950 has been preceded by an inverted yield curve. And, we got the talk that we're not going into recession, where somehow the United States is immune to what's going on in the rest of the world. Meanwhile, things couldn't possibly be worse here. If you were to listen to the propaganda ministry, I'm talking about CNBC, Bloomberg, Fox Business, they're going to tell everyone you're doing great. Of course, our lovely, illustrious thing sitting behind the Resolute desk will tell you that. Fed presidents will tell you that. The Fed chairperson will tell you how great we're doing. Janet Yellen, the Treasury Secretary, we're doing fantastic. But again, this yield curve is a big tell that things are not good and about to get much worse. And on top of that, we have what's called leading indicators. Indicators which tell us where the economy is going, again, leading going forward. And every single one, there is not one single leading economic indicator today that's pointing higher. They're all pointing towards things getting a lot worse moving forward. What people need to understand, I think, really is America, it's falling. America is falling. You have a situation, we're living on borrowed money. We're living on borrowed time. And it's going to get very, very real. And we've been hearing from institutions like the International Mafia Fund, the IMF, the Bank of Internal Settlements here, the central bank of central banks. Once in a while, you get a little bit of truth out of these institutions, and they're telling us what we already know. And I hate that. They're the authority figures, of course. But anyway, that things are bad, things are going to get much worse. Meanwhile, as you alluded to earlier, people walk around through time and space. They have no clue as to what's actually going on. And do you know why? Because they're not following your show. That's the truth. They're brainwashed and propagandized to the highest possible order as they sit there and they listen to the nonsense, deceptions, distractions, look here, don't look here from the mainstream media. It's unbelievable. I mean, if anyone were to pay attention to that, they would have no idea what's going on because, of course, they're being lied to and propagandized. It's just crazy. It really is.
So I'm happy you brought up recession, because we've been talking about recession since the tail end of last year, everyone telling us to prepare for a recession.
Yep.
And you're right, because the data we're seeing, like just today, we're seeing hiring by U.S. companies surge more than expected in June, pointing to a labor market that remains tight, even in the face of higher interest rates. This is according to the ADP National Employment Report. So here we have this data showing us there's no sign of recession, but yet we're being told to prepare for a recession. What's your take on this?
Well, at the same, the other side of that paragraph is, first-time jobless claims came in higher than expected. The data is fake. We're living in an environment of fakery like we have never seen before. Again, distractions, delusions, look here, don't look over there. I mean, we've seen this kind of tactic used against the people of the world since time immemorial. Honestly, towards the end of World War II, Germany was telling its people they were winning the war. The people were convinced they were winning the war because that's what the mainstream media was telling them at the time. It's an incredible thing. The same thing with, let's move into recent history. The meltdown of 2008, Ben Bernanke telling us everything was fine, everything was contained, don't worry about it. It's the same story. It just repeats itself. The data is not real, any of it. It's not checked by a third party that has any bearing on reality. The economy is in free fall. People are maxed out. It's interesting what they did here. I don't know if this happened to you or anyone that you know, but just several months ago, these credit card issuing agencies were giving people tremendous increases in their credit lines without even asking for it. They knew that people were going to go out and unfortunately be irresponsible and melt down their credit cards. And we've seen credit card debt, household debt, personal debt, consumer debt at their highest stages ever in history. We've never seen anything like it. People are done. We have major retailers saying, hey, you know what? The consumer is done too. They're strapped. We're getting warning after warning after. We just got a warning this morning from the Wall Street Superbank, Goldman Sachs, 5 reasons to believe that the stock market is about to take a big drop here. Look, all this comes down to risk in the market, which again you alluded to earlier. Risk in this market is rising. The stock market is so disconnected from any kind of reality. I've been doing this kind of a gesture in my videos for years, saying this is the stock market and this is the economy. At one point, this is going to get very real here. Valuations don't make sense in this market anymore. Nothing does. When you have a central bank, any central bank that is continuing to promise easy money to the market, well, it creates an environment where cash makes its way into risk assets and it creates massive bubbles and distortions across the spectrum of asset classes. And that's what we have right now. We have a stock market in la-la land. Way beyond that. A debt market hyper bubble beyond anyone's wildest dreams. And that's the greatest threat to everything because people don't understand. People always focus on the Dow. Look at the Dow Jones Industrial Average. No, look at the debt market, which is the driver. The stock market in aggregate is a derivative as to what is happening in the debt market. So the stock market, as well as housing and everything else, derives value from debt market action. The debt market is a time bomb. It's a ticking time bomb. It's going to go off. And it may actually be going off right now. Again, I have an indicator right on my website, traderschoice.net. It's free to everybody. I don't charge a penny for it. It's called the Mannarino Market Risk Indicator. Me and the people that follow my work have been watching this for months. 250 was the first line in the sand. We just crossed 250 with regard to risk in this market. The MMRI looks at the 10-year yield, the relative strength of the dollar, and puts it together in a neat little color-coded kind of a thing. It's so easy to understand. But risk in this market is that we have now crossed that threshold of 250. And just yesterday when we crossed, markets started to fall. Global markets overnight fell.
Why is it always at the 250 level, Greg? Why is it always at the 250 level? Just comes back down.
Yeah. It's interesting to watch because the Federal Reserve, or those that are controlling the system, which obviously is the Federal Reserve, who controls the economy? The Federal Reserve. Who controls the markets? The Federal Reserve, central banks. Who controls the world financial system? Central banks. It's not presidents, kings, queens, monarchs, or dictators. It's them. But, Bidenomics, of course, is working because he's telling us it is. Anyway. But the MMRI has, over months now, been telling us or showing us that whenever we got close to 250, all of a sudden a miracle happens. The 10-year yield would drop, the market would come down, risk would drop, more cash would move into the stock market. So I've been telling people for months, watch the 250 mark, watch the 250 mark, watch the 250 mark. And like I said, we just crossed it. Markets are not liking this. And I'll tell you something else, everyone who's listening. If action is not taken by central banks to keep rates suppressed more so than they are now, which is massively inflationary, by the way, people aren't supposed to know that, this market is going down a lot from here. Where's the bottom? Okay. No one knows. I mean, could we be on the threshold?
I want to bring that up.
But, yeah. Could we be on the threshold of a new market crash? Absolutely. But the big crash isn't going to begin or end in the stock market, nor the Dow Jones Industrial Average. It's going to begin and end in the debt market. And we are seeing the sell-off right now, yields rising, and that's a big red flag.
I got Greg Mannarino fired up, and I love when you are, but I have way too many questions in my head right now. Okay, let me break it down.
Yep.
I want you to help us make sense of what's happening in the markets, okay? Because, like you said, last week, the Nasdaq closed out its best first half of the year since 1983. The S&P 500 notched its best first half advance since 2019. They're saying it's because there's a surge in interest in AI stocks. The investor is back, Greg Mannarino.
Yep.
What's your take? Because, yes, we keep hearing get ready for a stock market crash, but we're not seeing this reflected in the S&P, in the Nasdaq, which so many had discounted at the start of this year.
Yeah. Well, again, it goes back to the disconnect, and it has a lot to do with this AI kind of fear of missing out right now. Look, like I said earlier, the market has no bearing on reality at all. And when you have a situation here where, in this case, the Federal Reserve has been artificially suppressing rates since Kingdom Come, well, since the last meltdown here, let me make this simple for people to understand. When a central bank gets in here and starts artificially suppressing rates, in other words, not allowing the market to set fair value, what it does is open up a doorway for cash to make its way into risk assets. Now, the market believed, or at least did up until recently, that the Federal Reserve was going to keep rates artificially suppressed, keeping that doorway open for cash to make its way into the stock market. And that's why we've seen this kind of jump up here. But markets always overreact either to the upside or to the downside. And I think this is, like I said, there's no connection to reality here. We don't even know, no one is smart enough to actually know where, let's say, the S&P 500 should actually be. How can I say that? Well, because again, you got artificially suppressed rates from now since 2008, which has opened up that doorway to reinflate a bubble here, a super bubble, beyond super bubble in the stock market, reinflate a housing bubble. And again, this mechanism of manipulating rates is what central banks do. And how do they do it? Let's talk about that for a nanosecond. How does a central bank say, hey, everyone, this is what we're going to do. We're going to keep rates at X, Y, Z. They can't just say it. You see, they don't have a magical wand. When the central bank says we're going to keep rates at X, Y, Z, they have to get into the market and make it happen. And how do they do that? They have to buy the debt. They have to create cash out of nothing, add digits to a screen and buy the debt. That's what they do, but people aren't supposed to know this. And this is really the root cause of why we're seeing inflation around the world. You can't have a situation where central banks print and add digits to a screen in any amount they want to, and we, the people, have to pay for this in the form of inflation. Again, it's very simple to understand. It's economics 101. You have all these extra bills in whatever form they exist being created to do whatever they want with them. The Federal Reserve does have a trading desk. The New York Fed has a trading desk. And yes, the Federal Reserve does buy large cap stocks to prop up the market. On top of, that's the plunge protection team, which is a real thing. Look it up. I tell people all the time. And they buy the debt market. So all of this, when you can't just, create cash from nothing and expect there not to be fallout. And fallout is inflation. A central bank's power resides in only one thing, and one thing only, and that is ability to inflate. If we can take away a central bank's ability to issue debt, or inflate, they die. We had an opportunity recently with this whole debt ceiling. You remember all the panic, Janet yelling, "Oh, we got to do something, we got to do something." No, because they understood the moment. The moment we just default, if we would have defaulted on the debt, that would have started to kill the Federal Reserve. It would have also caused a great deal of economic turmoil. But we could have ended central banking. And if one central bank falls, it starts a domino effect, and they all fall. Again, their power resides in their ability to inflate. And you have politicians, so our so-called government, which is not our government, again, it's the central banks that run the world here, looking for every reason and every excuse to continue to inflate, to fund this, to fund that, to fund the other thing. In the last month, we've watched the national debt go up nearly $1 trillion. $1 trillion.
So are you saying, Greg, they could have ended this inflation fight long ago? I mean, I'd love to be next to you when, the Fed minutes came out earlier this week. We know they took the pause. They're saying more rate hikes are coming because they're still not happy with what they're seeing on the inflation front. When minutes come out like that, what's going on in your head? Where's Greg at? Are you golfing? Are you grocery shopping? Are you paying attention?
Always paying attention. Look, this whole thing has been a farce that has been sold to the people of the world since day one. If you go back to my old videos on my website, on YouTube blog, you will see with that when we all found out that central banks were going to start raising rates because they really wanted to stop inflation, the first words out of my mouth were, "It will never work." Central banks are trying desperately to convince us that by raising rates, eventually a miracle is going to happen and inflation is going to drop. No, that it has nothing to do with that. The reason why a central bank raises rates is to cut off the availability of credit to especially small businesses who are dying because of this whole mechanism here, fulfill the corporate agenda because they can weather pretty much everything here, and to crush the consumer. That's what they're doing. They're deliberately killing the economy. Now, if a central bank really honestly wanted to stop inflation, they can do one thing. Any central bank has the power to do this. They go to the larger institutions and they say, hey, you know what we're going to do? We're going to have you raise your capital reserve requirements above zero. We have a zero reserve requirement right now in the United States and most developed nations around the world. A zero. In other words, these major institutions have to hold no cash in reserve. If, in fact, the Federal Reserve were to say to the Wall Street institutions, okay, everyone, you got to raise your capital reserves, what would that do? It would instantly contract the money supply. It's a money supply problem. They've been inflating since 2008, creating cash out of nothing. All of these bills chasing the same amount of goods. Sounds logical, right? That's why we're seeing inflation. Now, if we could contract the money supply, even just a little bit, that would slow inflation. It would stop it in its tracks. But no, the lie or the fable that continues to be sold to the people of the world is we're going to raise rates. We're going to raise rates. And eventually a miracle is going to happen. This is a lie. It's been a lie since day one and people are buying it. Why? Because they don't know any better. If people really understood the financial system, how it actually works, they'd be running for the hills. This is the truth. Very few people have an acute understanding of how the financial system works. And you don't learn this stuff in business school. You got to sit down and you got to dig through this. You got to do, I have studied the markets more so than when I studied medicine. I practiced for 20 freaking years medicine. I studied the markets more so than I had to study medicine to understand it. Because this thing is on a new level and it just keeps getting worse. That's what I'm trying to warn you.
I didn't even know that. You were a doctor?
I was a physician assistant for 20 years. And,
wow.
I was on the first line of defense. I did emergency medicine for 10 years, urgent care for 10 years after that. But it's crazy.
Not to digress. I didn't know that. But getting back to numbers here, you've been saying that the U.S. 10-year yield is 4%. The relative strength of the dollar lower right now, and my question is, what were to happen if it were higher, right? Mm-hmm. Mm-hmm. And it's very simple. You
can see what's going on here. I mean, let's put that into perspective as well. What do we know has happened? The Federal Reserve, central banks of the world have been keeping rates suppressed. And that, again, I was saying, it opens up a doorway for cash to make its way into risk assets, in this case, global stock markets. All right, very simple to understand. In the reverse, okay, if rates start to spike, and I believe we're going to get an uncontrolled sell-off here at one point. Is it beginning right now? It very well may be, but we'll see where this goes here. Central banks have been pretty crafty. Are they going to start buying more debt, suppress the 10-year yield, let's say, because the 10-year yield is the benchmark? Let's see what happens here. But just think about it. In the same way that suppressed rates have inflated a massive bubble in the stock market, What would it do if rates did the opposite? Obviously, it would put pressure on the stock market. I believe that the scenario is going to unfold like this, and it's very, 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 very simple to understand. Again, the debt market being in a hyper bubble beyond anyone's wildest dreams, it's going to burst. Eventually, the debt market bubble is going to pop. You're going to see a spiking, like we're seeing now, uncontrolled spike in the debt market. The 10-year yield could spike 20 basis points per day, 40 basis points per day. What would that do to the stock market? Well, it would start to close that door that cash has been moving its way into the stock market, so the stocks will sell off. You got cash bleeding out of the debt market, putting pressure on stock markets, cash bleeding out of the debt market. Where does it go? Does it just fly away and go to money heaven? Is that where it all goes? No, it doesn't. It just goes from one reality into another. So cash is going to, again, leave the debt market, leave the cash market, and it's going to go right into commodities in a big way. People have no idea. You want to talk about inflation or high prices? Commodities are going to skyrocket when this whole thing.
Well, I'm going to stop you there because I want to ask you, when you were saying people are going to run for the hills, I was thinking, where can we run to? Because right now, if I'm looking at cryptocurrencies, relatively flat, except for Bitcoin Cash, which has been on a run. Crude oil flat, even though Saudi Arabia says they will do whatever it takes to keep the price of crude oil higher. Gold, not very exciting these days. But talk to me about why you've always loved commodities, but why you love it more now. Is it the only play for you?
Well, like I say, because eventually that's how it's going to play out. Debt market meltdown, stocks fall under pressure, cash just moves. It will move into suppressed assets. Commodities priced in dollars, and the dollar is obviously a dying asset along with every other central bank issued currency. They're all in a race to the bottom. They've been killing their currencies or sucking the purchasing power out of their currencies for years. And again, it's insane to see who can do it faster, and that's another reason why we're seeing inflation here. Again, it's a product of an overproduction of fiat currency, and eventually, again, the environment that is created again by suppressed rates creates this risk-on environment. Cash makes its way into risk assets, like I said, stock markets and real estate hyper bubble. And markets generally tend to run in cycles. Risk on, like we pretty much have seen, where stocks go up, and then risk off, where it's a commodity cycle. So you get these waves, but we've never seen anything like this. This has gone on so long, and it's got so grossly out of control. I mean, this is how I think of things. And again, I'm open to hear anyone else's ideas, but I haven't heard a better one, so I'm going to stick to mine. We don't know where the bottom is of this market. We just know it's grossly overvalued, not just by what I'm saying. I'm telling you, you got Wall Street super banks saying the same thing, billionaire investors saying there's something is going to break here. And they've been saying it for a long time because they see the same things that we all do, anyone that understands these markets. So eventually this is going to change. And the bubble again, that exists is all because of this debt market, which is running the world right now into some kind of a twilight zone. It's not real. We have a completely fake environment that has been engineered by central banks who are keeping rates suppressed now for way, way too long. There's going to be a terrible price to pay for this. Now, again, going back to what I was saying here, we don't know where the bottom of this market is. What we do know is the Federal Reserve jumped in here at Dow 6,000 to start quantitative easing. The market would have dropped lower than that during the last meltdown. The Dow topped out at like a little over 12,000 at that point. We cut it in half. The Fed jumped in here. But where's the bottom? Again, no one knows where it is. So with that said, in a full-on market meltdown, the bottom could be today lower than 6,000, or it could be 6,000. We don't know. But all we do know is it's going to be multiples lower than what we have. I believe we're going to see a 1-to-1 ratio with regard to the Dow Jones Industrial Average and gold at one point. So if we get Dow's 6,000, we're talking about gold 6,000. And think of what that would mean for silver if it goes to a 15-to-1 to gold, or even a 10-to-1, because the markets always overreact. Like I said earlier, it always goes too hard one way or the other. This whole thing is just so twisted and it's so distorted. It's very difficult to get your head around. But what we do know is this is not sustainable, because we're seeing a side effect. This is what I call the moment of maximum saturation, something I've been telling people for almost 10 years. At one point, we were going to see these things unfold. And the first stage is inflation. Okay. Again, you can't have a situation where central banks have done what they've done now for over 10 years and not have a side effect of inflation. They knew it, and they have engineered this, and they're not stopping inflating, and they have no interest in actually slowing down inflation, because if they did, they would have the institutions raise their capital reserve requirements above zero. So you see what I'm talking about? It's so in our face. If you just outline these things, it makes it very simple to understand.
I'm going to wrap part one there of Greg Mannarino. We're going to be right back because we still haven't spoken about Fed now. So you're going to want to watch part two. Stick with me, Greg. We'll be right back.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.